I don't know if you've noticed, but it's almost December, which means it's time to start thinking about end of year stuff that you ought to do if you have an investment portfolio. Let's start with tax loss harvesting. Do you want to explain a little bit about what tax loss harvesting is?
Yeah, so let's say that Gabby invests in, I don't know, Gabby, like what? Apple? Give me a company.
No, let's go with Apple. That's
Let's go with
fine.
Apple. Let's say Gabby buys shares of Apple and then shares of Microsoft. And then during the year, her shares of Apple go up 30% and her shares of Microsoft, let's say, go down 30%. Well, let's say that Gabby needs to sell her Apple stock, but she doesn't want to pay taxes on that gain. Well, what she can do is she can sell her Apple stock and take that gain, and then also sell her Microsoft stock, take that loss, and then you can offset it. And that's what tax loss harvesting is. It's selling losers to offset your winners for tax purposes.
Absolutely. So a few things that you want to keep in mind with tax loss harvesting is one, you can apply up to $3,000 a year in capital losses towards lowering your total adjusted gross income, which is great. But you can also do the thing that Maxfield was talking about, where you take your losses and offset your gains. But if you're going to do that, you have to keep in mind that they have to match. So if you're offsetting short-term gains, you have to do that with short-term losses. Does that make
Right.
sense? And if you want to do that, you can do that too with long-term gains and long-term losses. It works for that too. Of course, if you have a short-term loss, for example, of $8,000 and only $2,000 in short-term gain, then you can apply the remaining, say, $6,000 to your long-term gains if you have that.
Yeah, yeah, and it really is when you're talking about investing. Anytime you can reduce your costs, and taxes are one of those costs, you're effectively increasing your return. So anything that you can do in that regard, and tax law harvesting is absolutely one of them, is a good thing for investors to keep in mind, just as a tool in their toolkit.
Absolutely. So other things that you want to think about before you sell is check your cost basis before selling. Maybe that'll influence you either way. You obviously want to sell depreciated investments if you're going to do tax loss harvesting. But you want to try and get rid of the ones that don't really fit in with your strategy, whatever your strategy may be. And you obviously want to hold on to stocks that fit your long-term goals.
Yeah, and to that point, and
Don't sell
I
things
suspect
willy-nilly is what I'm saying.
exactly, and I suspect that Gabby, you were going to bring this up, but it can even be a part of rebalancing your portfolio. Looking at your portfolio at the end of the year, seeing where your stocks have, how they've changed, seeing what percentage certain stocks are taking up of your portfolio, and if some are taking up more than others, you want to take those gains or take those losses to offset those gains. It can all kind of factor into that rebalancing of your portfolio.
Absolutely. And just to throw this out there, the Motley Fool philosophy is, of course, to always look for diversity and to look for long-term investments that you really believe in. So just keep that in mind when you're rebalancing your portfolio.